Welcome back to The Explainer. Today, we are mapping out a massive collision course. For the trading week of August 24th through the 29th, 2026, we're looking at a market caught right between massive global policy shifts on one side and highly granular Euro USD technicals on the other. If you're trading the euro or the dollar this week, you really need to understand the fundamental tectonic plates shifting beneath the charts. We have interventions in the bond market, we've got Eurozone economic resilience, and hanging over all of it, the highly anticipated debut of a brand new Federal Reserve chair. And that brings us to the ultimate question driving the markets right now. What exactly happens when a new Fed chair outright refuses to tip his hand? We're going to explore the mounting market tension as Federal Reserve Chair Kevin Warsh prepares for his debut keynote at the Jackson Hole Economic Policy Symposium. You see, Warsh has totally moved away from traditional forward guidance. He hasn't told us if he'll talk about the macro big picture or give us a concrete policy path, and that is making this speech wildly unpredictable. The market hates a vacuum, right? And right now, Warsh is creating a massive one. Here is our quick roadmap for the week. We'll cover Warsh's debut at Jackson Hole, U.S. debt and dollar headwinds, Eurozone resilience and the ECB, the EUR USD technical setup, and finally, exact scenarios for the week ahead. Okay, let's dive into Section 1, Warsh at Jackson Hole, easily the absolute biggest driver of the week. Now, timing is literally everything for active traders. So here's your chronological map of when the volatility is going to strike. The symposium kicks off with off-the-record interviews starting as early as Wednesday, which often features the Kansas City Fed president. On Thursday at 8 p.m. Eastern, we get the full agenda release. But the climax, the exact moment everyone is waiting for, is Friday at 10 a.m. Eastern. That's when Chair Warsh delivers his live, televised keynote address. And here's a vital detail to keep in mind. There will be no Q&A session following his remarks. He speaks, and then he just leaves the market to digest his words without any clarifying follow-ups. The context Warsh is walking into is incredibly tense. We are seeing the sharpest internal divide at the Fed since 2016. At the July meeting, we saw a 9-3 split. While 9 members voted to hold rates, 3 regional presidents, Hammock, Kashkari, and Logan, all actively dissented, voting for a rate hike instead. Warsh actually brushed this off, calling it a healthy family squabble. But for the markets, it shows real hawkish pressure building within the committee. Warsh has to address this divide, or at least acknowledge the conditions driving it, when he takes the podium. Because Warsh hasn't provided that forward guidance, institutional strategists are really sounding the alarm. Molly Brooks, a U.S. rate strategist at TD Securities, points out that there's an asymmetric risk heading into Friday. She notes it's highly likely to be disappointing to markets if he doesn't come out with enough information. If he fails to clarify his policy framework and his reaction function, it's going to severely shake things up. There is a lot of downside risk and volatility baked into a scenario where he just stays vague, because the market is desperately seeking clarity on how the Fed will actually handle inflation and growth moving forward. Zooming out from the Fed, let's move to Section 2, U.S. debt and dollar headwinds. The U.S. bond market is facing immense, frankly unprecedented pressure. The 10-year Treasury yield has hit 4.734%, and the 30-year yield has climbed to a staggering 5.274%, which is its highest level since 2007. Why is this happening? Well, it's a toxic mix of a massive U.S. budget deficit nearing 6%, continued Middle East uncertainty, and massive new corporate debt issuance driven by AI-related borrowing. This pressure is so intense that the U.S. Treasury has been forced to intervene. They've actually doubled their long-dated Treasury buybacks to $4 billion per operation just to try and contain these long-end yields and inject some liquidity. So, the crucial point we have to consider is this. Does this level of intervention undermine the dollar's credibility? Treasury Secretary Scott Bessent has hinted at fiscal consolidation, but honestly, few believe it will actually fix a 6% deficit. If the Treasury has to step in aggressively just to contain long-end yields, it raises serious doubts about U.S. fiscal discipline. And when policy credibility is questioned, the dollar's traditional safe haven appeal gets severely dampened. Investors naturally start looking for alternatives with a little less debt baggage. Let's shift our focus across the Atlantic for Section 3, Eurozone resilience and the ECB, to see exactly where that capital is flowing. We are looking at a classic macro tug-of-war here. In the U.S., we have the constraints we just discussed, heavy debt, intervention risks, and rate uncertainty. But in the Eurozone, despite the conflict in the Middle East and sustained high energy prices, we're seeing modest but continuous economic growth. They have much stronger fiscal discipline relative to the U.S. right now, and because of those lingering inflation risks from energy prices, the European Central Bank has plenty of room to maintain a hawkish stance. Basically, investors are actively fleeing the debt-heavy U.S. dollar in favor of the euro structural stability. A perfect numerical example of this resilience is 52.8. That is the latest Eurozone Manufacturing Purchasing Managers Index, or PMI. It unexpectedly improved this month to 52.8, up from 51.9. So while the US is starting to show signs of an economic slowdown, European hard data and surveys are actually beating expectations. They're shrugging off the macro headwinds, which gives the euro a distinct fundamental advantage over the dollar this week. So, Section 4. How does this fundamental macro narrative build directly into the granular technical setup for the EUR/USD pair? For active traders, knowing your exact battlefield is everything. We are currently hovering right near the 1.1675 level. Down below us, we have a very solid key support zone between 1.1640 and 1.1660. If the pair dips, that is the floor traders are watching for a bounce. Above us, we've got a clear ladder of upside targets. The first resistance to clear is 1.1710. If momentum carries through, 1.1750 is the next ceiling, ultimately opening the door to the major 1.1800 handle, which lines up beautifully with longer-term Fibonacci retracement levels. Now let's add just a bit of context to those levels. Technically speaking, the broad bear trend in the EUR/USD has been definitively broken, meaning our baseline forecast right now is mildly bullish. However, if you look at the 4-hour intraday charts, a shooting star reversal pattern has recently formed right near the upper bands. This strongly suggests we might see a brief, short-term correction, a quick pullback right down into that 1.1660 support zone before the bulls regain control for an upward continuation. Plus, the 200-day moving average is sitting right there just below these levels, heavily reinforcing that lower boundary. All right, Section 5. Let's synthesize all of these technicals and fundamentals into actionable scenarios for the week ahead. The market's next major move hinges on two distinct paths out of Wyoming on Friday. In step 1, the hawkish scenario, Warsh comes out swinging. He acknowledges the 3 dissenting Fed votes, emphasizes higher for longer rates to fight inflation, and immediately sparks a US dollar rally. In this case, expect the euro's run to snap, sending EUR/USD plummeting down through our 1.1660 support. But in step 2, the dovish or silent scenario, Warsh either gives no forward guidance at all, or he leans into his unique AI disinflation thesis, the idea that AI productivity is going to naturally lower inflation long-term anyway. This would absolutely crater the dollar's remaining appeal, sending EUR/USD soaring right through 1.1750 and setting its sights squarely on 1.1800. So as we head into what is guaranteed to be an incredibly tense Friday morning, you have to look at the charts and ask yourself, which side of the sea asymmetric risk are you actually prepared to trade? The euro definitely has the fundamental and technical upper hand right now, but his single speech can completely rewrite the trend. Will Warsher's silence ultimately break the dollar's remaining credibility, or will a sudden hawkish shock absolutely break the euro's impressive rally? Keep a close eye on those key support and resistance zones, and trade safe this week.